Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. Welcome to today's podcast, where our main goal is to share insights that hopefully help you become a better investor. Today's episode will be a bit different. Instead of interviewing a guest, like I normally do, I like to share personal insights from my 25 plus years in the investment world. During this time, I've had the privilege of advising on billions of dollars in client assets through both roaring bull markets and some of the biggest bear markets in history. I've also had the honor of learning from some of the greatest minds in finance, many of whom have been guests on this podcast. We've certainly had some incredible guests, and they've shared all sorts of insights on how to get an edge in investing. But here's the thing I've noticed. When you really listen to these great investors, there's a common thread. They're not just focused on finding the next big opportunity. More often than not, they're really good at avoiding the big mistakes that can really set you back. So today, I want to flip the script a bit. Instead of chasing after that elusive edge, let's talk about the common pitfalls that even smart investors fall into. Because it may be easier for some to avoid these mistakes than to try and learn and maintain an edge. All right, let's dive in. I'm going to walk you through what I think are the 4 biggest mistakes investors make. I've seen these mistakes pop up again and again, no matter how experienced the investor. And I hope that by shining a light on them, you might recognize 1 or 2 that resonate with you and perhaps allows you to avoid making the same mistakes in the future. Investing at its core is guided by a set of fundamental principles. This is one thing that I've learned that are completely logical and have withstood the test of time. These first principles form the foundation of sound investment strategy, in my experience. Yet time and again, I've witnessed investors, from novices to seasoned professionals, even those who have been in the business a very long time. These people often make decisions that directly contradict these first principles. So what are they? Number 1, don't put all your eggs in one basket. Seems very elementary, but I've seen so many people violate this very simple rule. And I think a lot of it is just unknowingly violating it, which we'll get into. Number 2, buy low, sell high. These are very simple concepts. Everybody knows this one, but most do the exact opposite, and it's for understandable reasons. Number 3, invest for the long run. We've heard this many, many times. The challenge is that the long run often extends beyond what many investors realize. And I've noticed its definition seems to be getting shorter over time. And the 4th one, which we'll cover today, is avoid overconfidence in your ability to predict the future. Everywhere I look, smart people are trying to predict what comes next, and they make a very compelling case. But I've found that if you look at it objectively, they're often wrong far more than many realize. So we'll dig into that one as well. Don't put all your eggs in one basket. Buy low, sell high, invest for the long run, and be very careful about trying to predict the future. Seems very obvious, very logical, but these first principles are, in my opinion, far too often violated. Let's talk about the first one. Don't put all your eggs in one basket. Let's start with diversification. That's basically what that is saying. I think it's important to discuss why diversification is so important. We've heard of the saying, diversification is the one free lunch in investing. And the way to think about that is if you are well diversified, you can effectively get similar returns for less risk than if you're less diversified. And so think of that as the free lunch because you're not really giving up anything. You're not really giving up returns. You're just taking less risk to get to the same place. So it seems like that's something investors should think about taking advantage of. There's no reason not to. So that's why it's important. The next point I'll make is, and this is something that I think a lot of people don't fully appreciate, is that the conventional portfolio is not well diversified. I'll start with a quick story. This was probably a decade ago. I had lunch with a portfolio manager who was managing a, air quotes, balanced portfolio. And the strategy was a 60-40 type of approach, meaning a target allocation of 60% stocks, 40% bonds. And that's commonly referred to as a balanced portfolio. That's very conventional. And many investors use that as a starting point to build their portfolios. And so we were having lunch and I asked them, I said, I just have a very simple question. And by the way, he'd been managing this fund for 30 years. He'd recently retired. And it seemed like he'd done well. Returns were good. The fund had grown significantly in size, well-known firm. And I said, well, let me ask you a simple question. Why do you call it a balanced portfolio if it's not balanced? And he looked at me and he said, what do you mean it's not balanced? Everybody knows 60-40 is a balanced portfolio. And I said, yeah, but how can it be balanced if that 60-40 portfolio is 98% correlated to the stock market? So he said, no, that can't be true. You have 60% in one asset, 40% in another asset. And on average, those two assets are not correlated to one another. Therefore, that 60-40 portfolio can't be almost 100% correlated to one of those assets. He said, that doesn't conceptually make sense. And I said, no, I think you're missing something. The 60%, the stocks, are far more volatile than the 40% in bonds. And you're overweighting the asset that's far more volatile. Therefore, directionally, the volatile assets that you're overweighting essentially drives directionally how that portfolio does. If stocks do well, portfolio does well. If stocks do poorly, portfolio does poorly. It's almost 100% correlated. He had this look on his face. Something was explained to him that he hadn't even thought about before, even though to me it's just very obvious. And he said, I've never looked at it that way. But let's talk about it a little bit more. So we talked about it. And I said, you can just do the math. You can open up an Excel spreadsheet. You can put 60-40 returns, and you can calculate the correlation to the stock market over whatever time frame you want. The longer, the better. And the correlation is going to be in the high 90s. And I said, and if that's true, it can't be balanced. It can't be well diversified by definition. If you have a total portfolio that is almost 100% correlated to any asset, that can't be diversified by definition. And he said, well, if that's true, I agree with you. And he said, when I get home, I'm going to run the statistics myself. And he did. And the next day he called me and he said, I'm so embarrassed. I've been managing this portfolio all this time. It's almost too simple of a question to think about and to ask. And he said, I'm embarrassed and I'm really glad we had this conversation, but I feel like I didn't do my job in making investors aware of this. Very, very simple measurement that you can do in minutes. It hit me that, wow, this was their life. For 30 years, they didn't see this very simple thing. And I think part of it is we get so caught up in our work and managing portfolios. And sometimes the most simple questions are never considered because you're just past that point. And I think it's easy to look around and say, this is the way everybody does it. It's probably the right thing. And every once in a while, somebody comes around, oftentimes somebody who isn't steeped in all this, and asks these simple questions, and it really makes you rethink it. And by the way, this isn't something that I discovered on my own. I learned this by talking to really smart investors. And once I learned it, it struck me as something unusual. So I spent some time thinking about it, researching it. It's one of those things that once you understand it and the light turns on, you want to share it with others because it's such an important concept that is widely misunderstood. So I think that's one of the big rules that are constantly violated is all the eggs are in the stock market basket. And that's a very risky basket in which to bet your portfolio on. And the reason isn't because stocks are volatile. Everybody's aware of that. And it's somewhat because we know stocks can drop a lot. And I guess the philosophy is just don't sell when it drops and you'll be okay. But the part that I think most people miss, because they're probably too zoomed in, if you zoom out, it's more obvious, is the stock market can go through very long periods where it does poorly. And to give you an example of that, if we just think about the S&P 500, the beloved S&P 500 that has been on a long bull market for 15 years now, it's gone through long stretches where it's done poorly. So if we go back almost 100 years, we had a 20-year stretch from 1929 to 1949 where the S&P averaged 0% a year for 20 years. Then it averaged 17% a year from 1949 to 1966. So a great bull market. Then from 66 to 82, it averaged 5% a year for 16 years. And that 5% sounds okay, but cash earned about 7% during that time. So the S&P underperformed cash by almost 2% a year for 16 years. Then from 1982 to 1999, we had a historic bull market for 17 years. The S&P averaged 20% a year. It's hard to imagine an average of 20% a year for 17 years. And just when you thought that stocks would go to the moon, you had a 9-year stretch where the S&P was negative 6% a year from 2000 to 2009. And we had two 50% drops. So you experienced massive volatility and you averaged negative 6% for 9 years. And since the global financial crisis lows in March of 2009, the S&P through September has averaged 16% a year for 15 years. So you go through these long periods where great returns and long periods through terrible returns. And the average over that full period has been about 9%. During the bull markets, those long-term bull markets, 18% has been the average. And during the long-term bear markets, the average has been 0. And so in some ways, you could think of it as a coin flip because those bull markets and bear markets each have made up about half the time since 1929. So if you think about it from that perspective, it's almost like a coin flip. Heads you win, tails you lose. And it's not that clean because those time frames, it's hard to know when you're in a bull market and when you're in a bear market until time has passed and you can look back and see the clear inflection points. But if you just look at that data and you're thinking about the bet that you're making in investing, and if all your eggs are in that stock market basket and you just happen to get tails and it's a bad 10, 15, 20-year period, that's really hard to recover from. I think the main point is you don't have to take that risk. My sense is that many investors, many professionals are taking that risk, not fully appreciating how big of a risk that is. And so I think that's part of the reason this rule of don't put all your eggs in one basket persists, is there's just not a full appreciation that that risk is actually being taken. So let's talk about how do you conceptually get more diversified than basically betting all of it on the stock market. Conceptually, the way to think about it is to invest in multiple return streams. Think of each of these asset classes or managers or strategies as return streams. It's a stream of returns that is unknown what it'll be, but you have some sense based on history and understanding of how the fundamental pricing works. But they're each streams of returns. And what you want is a bunch of return streams that are individually attractive, but diverse to one another. And part of that analysis is backward looking. How have they done in the past? What has been their diversification in the past? But you also have to consider what the future may bring in terms of those returns. And I'm not talking about predicting the future. I'm talking more about appreciating what caused those returns in the past. And are those causes going to be the same or different in the future? So part of it is understanding the environment. Was it during a falling rate environment? Was it during an inflationary environment? Was it during an economic boom, et cetera? So you got to look at it through those lenses. But if you can find individual return streams that are attractive yet diverse, because what drives their returns is diverse, the drivers, that's the key. If you can put all that together, then theoretically, and we're still talking at the conceptual level, you can build a really well-diversified portfolio of these individual return streams and benefit from that free lunch of diversification. So if you just think about it, if you can find 10 things that have an equity-like expected return, but don't necessarily go up and down with stocks, so they go up over time, but they go up and down at different times, that should produce a more consistent return through time than one that has all its eggs in one basket. Okay, so let's go one level down from there. The way I think about all these return streams is to categorize them into 3 different categories. Category 1 are public markets. So these are investments that are easy to access. They're relatively low fee. If you're a taxable investor, you can access them through ETFs where you have very low taxes. And the goal there is to try to find a diverse mix of those asset classes. So that's category number 1. Category number 2, I call them hedge funds that hedge, strategies that are going long and short markets. Some are public markets, some are private markets. But the key is that they're hedging the market risk so that you're not just investing in something that goes up and down with the stock market and you're paying more fees and getting worse terms, but something that is truly differentiated. Call them low correlated or uncorrelated to public markets. The third category are private markets. So that falls into the groups of private real estate, private equity, private credit. There's a lot of other truly uncorrelated private markets. So those are the 3 categories. So let me zoom in on each of them one level further. Public markets, most people think about stocks and bonds, and they try to diversify across stocks and bonds. I think you can even get more diverse than that. And this is relatively easy to do. So stocks, there's global stocks, not just US stocks. So you can diversify across US, non-US, emerging markets, and so on. There's maybe 13,000 or so stocks, and being more diverse, I feel, is better than trying to be more concentrated. Now, that hasn't been the case for a while, as US stocks have been the place to be, but that doesn't persist through time as market cycles play out. So diversified portfolio of stocks. Bonds, there's a wide range of bonds. I like to emphasize high quality bonds because what you want the bonds to do is outperform when growth is weak, when stocks fall, and you want them to provide that diversification benefit. So assets like treasuries, I think, are interesting in terms of a diversification tool. Inflation-linked bonds is another important asset class. I think that's heavily underutilized in portfolios. You think of that as a hedge against rising inflation, which can cause both stocks and bonds to do poorly at the same time. So inflation-linked bonds are tips. Assets like gold, which has been around a long time, and you have to look at the returns since 1971 when we came off the gold standard. It's a lot better than most people realize. It's not that far off of stocks for 50 plus years. And then commodity producer equities, the companies pulling the commodities out of the ground, returns have actually been very high. It's a really good diversifier. So those are just simple examples of other assets that are publicly traded, easy to access, and they're the focus because it's a relatively efficient space, public markets. It's hard to outperform because there's just a lot of information, there's a lot of players competing. So there I tend to focus on minimize fees, minimize taxes if you're a taxable investor, and maximize diversification. To me, that's low-hanging fruit. And if you can do those things, then you'll probably be ahead of most people. Because in my experience, most try to be active, so their fees are higher, their taxes are higher, and their diversification isn't as good as it could be because it's mostly concentrated in stocks. So that's public markets. Hedge funds that hedge look for strategies that exhibit low correlation and understand what drives the returns and why you should expect low correlation. And very good stress tests is periods like 2022, when both stocks and bonds fell considerably. Managers who were up during that time or held up really well, it's a good stress test. 2008 is another good stress test. First quarter of 2020, when COVID hit, is another good stress test. And then just understanding fundamentally how they manage the portfolios. But the focus there is things that are diversifying to public markets. And then private markets look at all these different segments in less efficient spaces. My experience with private markets is there's a lot of room to have operational efficiency beyond what the average investor does to generate excess returns. There's less liquidity, the market's more fragmented, there's just more opportunity to have an edge. It takes a lot of underwriting, but there's potential to add returns through time, and you can be diversified. So think about it if we take a step back. Public markets, be diversified within public markets. Hedge funds, focus on strategies that exhibit low correlation. Private markets, a lot of opportunities there. And you put all that together, that portfolio is far more diversified than one that is effectively putting all its eggs in the stock market. And the way to conceptually think about it is you have a spectrum. On one end, you have what everybody else does, which is think of it as a 60-40 type of framework where all the eggs are in the stock market basket. That's conventional, but it's not that well diversified for the reasons that I described earlier. On the other end of the spectrum, on the far other side, you have a super diversified portfolio that includes all these return streams that I described. Diversified public markets, hedge funds, private markets in a diverse way within each of those. And that portfolio is way more diversified than one that is basically putting all its eggs in the stock market basket. And so think of that as a spectrum. Each investor should understand two things. First off, that there is a spectrum. It's important to know that you have choices across all these things and to recognize that there is a spectrum. So I think that's number one. Number two, and I think professionals also have this responsibility, is to think through where along that spectrum is the right point for each investor. And it's not as simple as saying, on paper, more diversified is better because we don't live on paper. We live in the real world. And people have biases. They have reference points. Where are you comparing yourself to? They have various time horizons, different levels of sophistication, different levels of access to all these things. So each investor should recognize there's a spectrum, try to figure out where along that spectrum is the right point for them, because you have to factor in all these other influences in determining whether you have a successful investment journey or not. And so, for example, if you're constantly looking at the stock market, like most people are, because that's what's on TV, it's what's in the paper, it's what people talk about. You ask somebody, how's the market doing? You're asking about the stock market. You're not thinking about the bond market or the real estate market or any other market. It's usually referencing the stock market. So if that's your reference point, the stock market's up 20 and you're up 5, are you okay with that? If the stock market's down 20 and you're down 15, are you okay with that? Those are important questions. And if you're referencing to the stock market to judge success or failure, then you should be closer to that side of that spectrum, more market-oriented portfolio, more conventional, less diversified. If you're truly a long-term investor, you appreciate a more diversified portfolio, it can get you to the same place through a smoother path. You've tested yourself. It's one thing to say it, it's another thing to actually do it in practice. You've tested yourself. You've been through 3, 5, 10-year periods where being more diversified gave you worse results than if you were less diversified. The last 10 years is a very good example of that. If you've tested yourself through those periods and you've held on and haven't changed your approach, then maybe you can be more on the fully diversified portfolio. And most people are probably somewhere in the middle. And so I think it's this personal journey. As an advisor, I'm thinking about what's the right point for each client. And you go through time and you're always trying to optimize for the right point along that spectrum. And the more education there is, you can probably be more diversified. The less emotion there is, probably more diversified. The less focus on near-term results, the more diversified. But there is probably a right point for each person. And so that's conceptually how I think about implementing all the thoughts that I just shared with you. Okay, so let's go to mistake number 2. This sounds very obvious. Buy low, sell high. If you're an investor, it makes sense. You buy things when they're down and you sell them when they're up. And that sounds like a pretty profitable strategy. I don't know if anybody would disagree with that. But the investment industry is unique compared to other industries. And one of the reasons is that markets and even managers are reliably mean reverting over time. And it's also very difficult to distinguish luck from skill. Particularly public markets are relatively efficient. So all of that introduces a lot of complexity. So what most people do, in my experience, is there's a tendency to follow momentum and chase returns, as opposed to being attracted to lower prices. And that's unique to the investment world. So if you think about it, if you're out shopping and something's on sale, you look at that and say, oh, it used to be $40, now it's $30. I'd rather pay $30 than $40. So that's pretty obvious and intuitive. In the markets, when something goes down, what people tend to do is they extrapolate past returns into the future. So if it's been going down, they'll look at that and not say, oh, it's on sale. They'll look at that and say, it's going to continue to go down. And I don't want to own that. So that is very interesting. Even though they know buy low, sell high, most people do the opposite. They buy high and sell low. When something has gone up a lot, whether it's an asset class or an individual security or a manager who's been outperforming, it's easy to look at that, look at the past returns and extrapolate that into the future. And so people tend to buy high and vice versa. When something's doing poorly, it's easy to extrapolate that into the future and want to sell that. Even though we know we should be doing the opposite, it's just really hard to do it in practice. And I think part of it is we see past returns. That's published, it's in front of us, we see those numbers. We don't see future returns until they happen. You have to, in some ways, try to predict what the future returns are going to be. Part of the challenge is not fully appreciating the cyclicality of these returns, meaning there's a warning out that's ubiquitous. It's past returns are not indicative of future results. We see that everywhere. Anybody who publishes returns, they are required to include that disclosure. It's often ignored in my experience. And I don't think it's intentional. I think it's just part of the way humans are hardwired. I'm sure many of us would nod our heads to, yes, I've seen that happen. I've probably done that myself. But the data also supports this. If you look at funds, they tend to grow in assets after a period of great returns, and assets tend to shrink after a period of poor results, whether if it's absolute or relative to some benchmark, whatever that reference point is. And I think the point of talking about this is people should just be aware of that natural tendency. And I think a lot of it is just emotionally driven. And it's also driven by the lack of appreciation that markets go through cycles. So usually the best periods follow the worst periods and vice versa. And I think it's because markets are relatively efficient and assets tend to be overbought and oversold. So those cycles tend to get exaggerated. So moving to implementing in practice, I'd say there's two ways to try to implement a process to buy low and sell high. First, which is probably more difficult, is to consider focusing more on adding underperforming asset classes or managers and reducing outperforming asset classes and managers. It can be very counterintuitive when you look at it in terms of backwards returns, but it should be more intuitive if you go back to the first principle of buy low, sell high, and also appreciating that markets tend to be cyclical. And to just delve into that a little bit more, the cyclicality tends to exist because when something is doing well, it attracts more investors and the price of whatever that is being invested in tends to rise, which makes it harder for the future prices to rise because in many cases it's overbought relative to the fundamentals. And you see that oftentimes in valuations. And as it gets more expensive, you're basically borrowing future returns today until it gets to a point where there's so much optimism in today's price that it's unlikely that how the future transpires will surpass that very high bar. There's more asymmetry, more likelihood that there's underperformance in the future. And then it goes the other way. And there's so much pessimism at the turn of the next inflection point where there's asymmetry in that there's a lot more room for upside than there is downside. And that's why these markets tend to be very cyclical. This is particularly in public markets where there's a lot more efficiency. And the same thing can happen with managers who go through stretches of outperforming the benchmark and underperforming the benchmark. Typically, what happens is there's a certain style that they employ in their approach, and styles go in and out of favor, similar to how asset classes go in and out of favor. And so it's easy to look at a manager who had outperformed over the last 1, 3, 5 years and expect that outperformance to continue in the future. But oftentimes, as styles go in and out of favor, that outperformance could be a predictor of future underperformance and vice versa. In other words, it's very difficult in efficient public markets to consistently outperform through time. And at the same time, it's very difficult to consistently underperform over time because it is relatively efficient. So in terms of a practical suggestion is to look for things that have underperformed, and then you can start to analyze why have they underperformed? Do I expect that to change? But at least there's an eye towards focusing on things that have underperformed. And at the very least, it offsets the natural tendency to just focus on the winners. It's so easy when you look at your report, your eyes immediately go to the things that have done poorly. And the natural response is, okay, these have done poorly in the past. Therefore, they're likely to do poorly in the future. Let's get rid of those and add more things that have done well. That's buy high, sell low. The point of this is just to bring that to the fore so that you're more aware of that natural tendency. And one way to try to offset that, at least get back to neutral, is to think about proactively looking for things that have underperformed. If we move into the institutional world, I work with a lot of institutional clients, it can even be more challenging because trustees, consultants, institutions, they are typically fiduciaries and it's not their money. They're in charge of managing somebody else's money. They're a pension fund and an endowment foundation, et cetera. And buying things that have done poorly, if they continue to do poorly, you could be embarrassed and you can look like an idiot. And so in practice, it's even more difficult. So the point of this is just to make you aware of that. And hopefully you can minimize the risk of buying high and selling low and at least try to offset it a little bit. But it's good to be realistic about the challenges of implementing that in practice. So that's one way to buy low and sell high. The second, in some ways, is a little bit easier. It's this concept of rebalancing. And what I mean by that is you have a target allocation to managers or asset classes. And when one has outperformed, its allocation rises above your target. And the ones that have underperformed, the allocation falls below the target. And rebalancing is basically selling a little bit of the winners, whatever they are, and buying a little bit of the losers. It's a programmatic way to buy low and sell high. And you can do that continually through time. And what I found is it actually can add value over time. So going back to that fully diversified portfolio, if you have a bunch of return streams that are individually attractive, but diverse to one another, and you're allocating across all of them, and your discipline is when something outperforms the others, you sell a little bit and you buy a little bit of the underperformers. If you keep doing that, conceptually it makes sense that over time, you'll earn a little bit more than just the average return of all those return streams because you're repeatedly buying low, selling high, rather than just holding them through time. And you can mathematically show that as well. And the more diverse the assets, the return streams, there's more potential for more of a return enhancement by rebalancing. So on paper, the math is pretty compelling, but let's move into the real world. In practice, even that is not that easy because behaviorally, it's difficult to sell the winners and buy the losers. The emotional impulse is, these are losers, I want to sell them. These are winners, I want to buy more. So you have to do the opposite. Now, if you have targets and you can see the allocation versus the target, it's a way to try to simplify it. You're establishing that before you experience the winners and losers. So you're taking some emotion out of it. So that's why it's probably easier than the first point I made earlier, but it's still not easy. If you're a taxable investor, there's another level of complexity in that selling the winners often means you're paying taxes on the gains. So that complicates it even more in practice. We've seen that recently with the stock market going up a lot, bonds being challenged. You're supposed to sell stocks, buy bonds, and paying taxes is a deterrent against doing rebalancing in practice in that regard. And again, institutional investors where the portfolios are tax exempt, they don't have that tax hurdle to overcome, and they tend to have an investment policy with stated targets and ranges around that. And when an asset is above that target, it's probably more likely that they'll sell that and buy the assets that have underperformed because there's actually a policy written that forces that discipline. Okay, let's move to the third core investment principle that, in my experience, is constantly violated. So this is mistake number 3. Invest for the long run. So we've heard that. The challenge is that the long run is much longer than I think people realize. So let's start with, what are the benefits of long-term investing? Why do you want to invest for the long run? One of the keys to successful long-term investing is to benefit from compounding. Compounding is magic. You add returns on top of returns on top of returns, and that's how you get these big moves in wealth through time. So the first benefit is the potential for greater returns as investments have more opportunity to ride out market volatility and benefit from the powers of compounding. The other benefit of long-term investing is the reduced impact of short-term volatility as time allows investors to look past temporary market fluctuations and also less likely behaviorally to want to sell at market lows. Think of a graph. You can just take the stock market or even a more diversified portfolio and look at the graph. If you look at it very closely, the wiggles look pretty big. But if you were to zoom out, and the more you zoom out, the more like a straight line it looks. And so if you're, think of it as a short-term investor is looking zoomed in, long-term investors looking at it zoomed out. And the more zoomed out you are, the more likely you are to ride through those downturns and the less likely you are to sell low. Therefore, more likely to benefit from the powers of compounding. I'd say emotionally, it can also be less taxing. If you're looking at it closely, your emotions are going to swing with the markets. Great periods, you'll feel great. Terrible periods, you'll wonder why you're investing in the first place, and you'll go through these emotional swings. The longer term your perspective, the more you're zoomed out, the less emotionally challenging that experience would be. I've also noticed the more zoomed out you are, meaning the more long-term focused you are, the more diversification opportunities are investable because you're not looking at it over a short period of time. One of the challenges with that first principle, don't put all your eggs in one basket, being really well diversified, is by definition, when you're well diversified, certain things are going to be doing poorly at the same time that others are doing well. And so if you're zoomed in and your time horizon is too short, you're more likely to want to sell the things that are doing poorly and add to the things that are doing well. Whereas if you're really focused on the long term and you zoom out and you're looking at each of those return streams over longer periods of time, you're much more likely to hold on to them through their periods of underperformance. And usually, as we've seen, the periods of outperformance follow periods of underperformance, and you'll get to benefit from being patient. So those are the reasons to focus on the long run. Of course, there's challenges. So let me talk about that. And I feel like it's good to talk about these things so that you're more aware of them. And hopefully, by being more aware, you're better able to overcome some of those challenges in practice. Challenge number one, time horizon mismatch. And what I mean by that is most investors, in my experience, struggle to maintain a truly long-term perspective. And this could be due to short-term performance pressure. What I mean by that is there could be pressure to show positive results over relatively short time frames, quarterly, maybe annually, even 3 years is a short period of time. That can lead to impatience and short-term thinking that conflicts with long-run investing principles. And I think part of the issue there is that 5 years in investing is a short period of time, even 10 years. And the reason that's the case is because that could just be one environment, and environments shift through time. Whereas in the rest of the world, 5 years is a very long period of time. You can graduate college in 4 years. Think about going to college. 4 years was a long time, or high school. That's a long time. A lot happened during those 4 years. In investing, that's a short time. There's just a mismatch between what is long-term here versus long-term just about everywhere else. There's also what is called a recency bias. People tend to overweight recent events and performance. And during market downturns, this can cause investors to lose faith in long-term strategies. It's one thing to say, I'm a long-term investor, and then something bad happens. And you look at that and you extrapolate that into the future and you think, this is too much pain. It doesn't make sense for me to sit here. And then let's say you withstand that emotional pressure and it keeps going down. And then you say, I knew I should have acted on my instinct and I didn't. And now it cost me. And everybody has a point where they just give up and they react to that emotional impulse. And again, the more diversified you are, the less impact there is on that line item going down a lot in terms of the total portfolio. There are also several psychological challenges. I referenced a few, but there's this notion of loss aversion. And the way to think about that is investors feel the pain of losses much more acutely than the pleasure of gains. And this can lead to panic selling during downturns because you're experiencing pain and you want to do something about it. Again, investing isn't like the rest of the world in that way. And there's also this concept of fear and greed. These are very powerful emotions, and it can lead to very poor timing decisions that can harm long-term returns. And none of this is really helped by external pressures. So if you think about where we are today versus 20 years ago, there's more information available. It's online, it's on TV, it's in the papers. There's a heavy media influence, and there's constant financial news, market commentary. There's more of a sense of urgency to act, even though inaction may be the best long-term strategy. So a lot of this is externally forced. And I think that's one of the reasons this notion of the long term has been declining over time. There's also peer comparisons. Investors may lose patience if they see others achieving short-term gains. And again, short-term could be 3, 5, even 10 years. And that can lead to FOMO, fear of missing out. The first sign of it, it may be a small pressure, and then it just grows with time. And so it's easy to give in to that and want to act because it's just the way humans are hardwired is to react that way. So what are some practical solutions to try to keep the time horizon long and to fight the tendency to shorten your time horizon? So first off, it's recognize the benefits of being a long-term investor. The more you appreciate these, the more likely you are to overcome the obstacles day to day. This one sounds a little counterintuitive, but the less frequently you look, the less you'll be tempted to react to short-term volatility. I've just noticed that with clients, those who are looking at it all the time, they're more likely to react to the emotional impulse. And then finally, this whole notion of zooming out. I think of it as the external pressures are constantly forcing you to zoom in. That's the pull. And you should, in order to offset some of those pressures, think about always zooming out. So think of it as like the world pulls you in and you should be constantly focused on how do I zoom out? And the more zoomed out you are, the more clearly you can see the mistakes of zooming in and the more likely you are to maintain a long-term time horizon. And we've already established that having a long-term time horizon has all these advantages. So I think in terms of trying to offset some of the challenges with being a short-term investor is to go through those steps. And finally, the fourth big mistake that I've witnessed is a general overconfidence in the ability to predict the future. It seems like everywhere I look, there are market prognosticators that they sound smart, they make a very compelling case, but I've always felt that when you turn on the TV and there's somebody up there predicting the future, there should be a disclosure right under their name that says it's objective and it says the historical track record of predicting the future for this person is 50% or 55%. In my experience, if you're right 60% of the time, you're one of the best. And most people are probably 50% or less. And so if that disclosure was there, my guess is there'd be less focus on what those who are predicting the future are saying. But obviously that's not reality. Let's dig into this a little bit. On the surface, it seems very reasonable to an outsider to assume that experts in our industry should have better insight into what the future holds than the average investor. If there's somebody really smart and they sound really smart, it seems reasonable and logical that they should have some edge in predicting the future. Now, the data doesn't support that. And I think it's for a few reasons. One is, guess what? The future is inherently difficult to predict. It's hard to know what's going to happen next. Number two, there's limited useful historical data. I think there's a huge misunderstanding. There's a lot of data in markets, a lot, but most of it is noise. There are very few data points that are actually signal, meaning that they're very useful data points. And it's largely because a lot of the data is heavily influenced by the environment, and there's not that many environments. You could have one data point that is a very good indicator in environment A. You change the environment, whether that's growth, inflation, interest rates, any environmental factor you want to apply. You change the environment, and that data point, that leading indicator, is almost the opposite in that new environment. And so it's not as valuable as people realize without understanding the macro. And then number three, it's the surprises that really matter. It's the surprises that move markets. If your prediction of the future is commonplace, meaning many people would agree with you, like that's likely to happen, more often than not, that's already in the price. And even if your prediction of the future comes true, if it's already in the price, you don't really profit from that. So not only do you have to be able to predict the future and be right, but you have to be different from the consensus view. So you have a lot of people out there predicting calamity or something that is way off consensus. And guess what? They're wrong a lot. And maybe every once in a while they're right. And when they're right is when they're highlighted, but they might be right 1 out of 20 times. And it's the one that you hear, not the 19 times that they were wrong. So the track record, if you take all these people, it's not very good. And it's important for people to be aware of that. What else makes it hard to predict? Markets are very complex. There's so many variables that go into the future price, many of which are completely unpredictable. Global economies are interconnected. There are geopolitical events that influence markets. There are behavioral biases that affect decision-making, which we've already covered, that also influence prices. So a lot of times you've heard the saying, markets can be irrational longer than you can be solvent. Oftentimes markets don't act like they should. Maybe that creates opportunities, but those periods can last a long time. If you have a lot of inexperienced investors piling into something and the price goes up and you try to go against that, you could be out of business. So that's really hard to predict. It's almost like you have to predict what other people are going to think and what their views are and how they're going to act. There's a lot of randomness in markets. There are what are called black swan events, very random things, like COVID is an extreme example. There's a lot of random things that can happen that are not predictable. There's a lot of information out there. A lot of it is probably not that useful. I mentioned distinguishing signal from noise. There's an art in doing that. Correlations across markets constantly change. There's no stable correlations. A lot of the analysis assumes that asset A and asset B are not correlated to one another or have some stable correlation. Those shift through time. And a lot of that is environmentally dependent. So there's just a lot of complexity, a lot of things that you can never predict. And all of that feeds into the price, including behavioral biases that we've talked about. So trying to predict markets is just inherently very difficult. And I guess that the mistake, to reiterate it, is there's just a general overconfidence in the ability to predict where things are going to go. There's just a lack of honest data that is published and in front of all the viewers as to the historical track record of predicting the future. So what are the implications for investors? I'd say it's important to have humility in your investment approach and to appreciate the difficulty in predicting the future and that you're going to be wrong a lot. And so that goes back to the first point of being diversified within public markets. This is the more efficient space, harder to predict. And focus on being super diversified and to recognize that your emotions are going to pull you towards the thing that's done the best, and listening to the market seers and those who are predicting the future, and just know that objectively the odds of success are low. Focus on risk management rather than prediction. That's one suggestion I would make. And along the same lines, appreciate the benefits of diversification and long-term thinking. One principle I've always followed is diversification always trumps conviction, meaning you should be more confident in the benefits of diversification through time than in your ability to predict and to time markets. That's a hard thing. The odds of success are low. The benefits of diversification, odds of success are high over time. And so really emphasize that. That's where you can spend more of your time and your energy and focus rather than focusing on trying to predict where things are going to go. I feel like I threw a lot at you, and hopefully it was understandable. And my hope is that by listening to this message and maybe re-listening in 3 months or 6 months as a reminder, that you'll be more aware of some of the common mistakes that I've seen in my career investors make. And my hope is that you're less likely to make a similar mistake in your investment journey. Thank you for joining me today. Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.